The next 90 days won't just influence your financial future. They could make you rich or lock you out of the biggest wealth surge of the decade. And if you're not paying attention to what the Fed is about to do, you're already behind. In this video, I'll show you exactly why the upcoming Fed rate cut is about to flip the market upside down, and how beginners can position themselves before the rush starts. No guessing, no hype, just the blueprint the smart money is already following. Because here's the brutal truth. Markets don't wait for rate cuts, they explode in anticipation of them. And while everyone else sits on the sidelines waiting for confirmation, early movers walk away with the biggest gains. The next 90 days are the window, and if you miss it, you don't get it back. Here's what we're breaking down. Why the market pumps before the Fed cuts, which assets historically skyrocket during these windows, and the simple beginner plan to avoid losing time or money. But there's one warning sign inside every Fed cycle that tells you whether this moment becomes a massive opportunity or a trap, and almost no one sees it coming. Let's start there. My name is Mac, and I spend a ridiculous amount of time studying how interest rates quietly decide who gets ahead financially and who falls behind, especially during moments like the one we're entering right now. And here's something most beginners never hear. People don't lose money because they're slow. They lose money because they misunderstand the moment they're in. And when it comes to the Federal Reserve cutting rates, almost everyone misunderstands it. Most people think a Fed rate cut is a green light, like the economy is suddenly healing and the market is about to explode upward. But that's not what a rate cut means. Not even close. A Fed cut isn't a celebration. It's a symptom.
It's the Fed quietly admitting something underneath the surface is weakening, and we need to step in before it gets worse.
This is where the perception flips. Markets don't move because the Fed cuts rates. Markets move because they expect the Fed to cut rates. It's like seeing storm clouds forming before the rain. By the time the first drop falls, you're already inside. Investors behave the same way. The biggest moves often happen before the Fed acts, not after. This is why the next 90 days matter so much. We're entering the window where investors position themselves ahead of the rate cut, while beginners make the classic mistake of waiting until the Fed officially announces something, which is usually when the smart money has already moved. But here's the part almost nobody talks about. Before every major rate cut, there's a very specific economic pattern, a kind of pressure buildup, that tells you whether the cut will trigger a market rally or a deeper decline. Most beginners never see it. Most analysts barely mention it. But it appears in every major cycle, and it's already starting to show up again. And that's exactly what we're breaking down in the next block.
Before we talk about opportunities or strategies, we need to zoom out and look at what's really happening in the US economy, because this context explains everything about why the next 90 days could be explosive. Here's the truth. The Fed doesn't cut rates because they feel like being nice. They cut because financial pressure is building somewhere. So what exactly is breaking right now? Let's break it down in a way that actually makes sense. First, consumer spending is weakening. People are still spending, but they're doing it with more debt and less confidence. Delinquencies on credit cards and auto loans are quietly rising. Families are feeling the squeeze, even if the headlines don't show it. Second, the job market is losing momentum. It's not collapsing, but it's softening. Layoffs pop up in certain industries, hiring slows, wage growth cools, and suddenly this strong labor market doesn't feel as strong anymore. Third, businesses are tightening their budgets. Small businesses, especially, are reporting higher costs and lower margins. Borrowing has become expensive, expansion has slowed, and risk appetite is shrinking. Fourth, inflation isn't gone, it's just calmer. Inflation falling gives the Fed political room to cut rates, but it doesn't mean the economy is perfectly healthy. It just means the Fed finally has breathing room to pivot. When you add these four forces together, you get a powerful signal. The economy is cooling faster than the Fed wants. And this is where the window of opportunity begins. Because historically, when the Fed prepares to shift from fighting inflation to supporting growth, markets enter a very specific psychological phase. Investors start asking, is this slowdown temporary or the start of something bigger? Will the rate cut be a boost or a warning sign? Where will money flow first when liquidity returns? This uncertainty creates volatility, but it also creates openings. Openings that can be extremely profitable if you understand the timing, and extremely dangerous if you misunderstand what the Fed is reacting to. And here's the part that most beginners miss completely. There is one key pressure indicator that reveals whether a Fed cut will spark a rally or a recession. It's not CPI. It's not unemployment. It's not GDP. It's something far more predictive, and it shows up before the major move happens. That's exactly what we're breaking down in the next block.
Before you make a single move during a Fed pivot, you need to understand the most important signal in the entire cycle, the one that separates the rallies from the recessions. I call it the financial pressure indicator, not because it's a single chart or metric, but because it measures something deeper, how much stress the system is under right before the Fed steps in. Here's why this matters so much. A rate cut can mean two completely different things depending on the level of pressure. When pressure is low to moderate, a rate cut is like giving the economy oxygen. Markets often rally before the cut, and that momentum accelerates as liquidity returns. But when pressure is high, a rate cut is closer to hitting the emergency button, a signal that something under the surface is cracking. And here's the mistake almost every beginner makes. They treat all Fed cuts the same. They think lower rates equals bullish. Money gets cheaper equals things go up. But that's not how this works. You have to look at the pressure behind the cut. So what exactly makes up the financial pressure indicator? 3 things, simple to understand, but extremely predictive. 1. Consumer financial fragility. Are people falling behind on payments? Are savings dropping? Are credit card delinquencies accelerating? When households weaken, the entire economy becomes fragile. 2. Business liquidity stress. Are small businesses reporting tighter margins? Is borrowing becoming too expensive to sustain growth? Are defaults rising? Businesses are the engine of risk-taking. If they slow down, markets feel it. 3. Labor market softening, not job collapse, just cracks. Slower hiring. Seasonal layoffs that don't fully reverse. A dip in job openings. The job market doesn't need to break. It just needs to tilt downward for things to change fast. Now here's the key. If all 3 signals rise together, the pressure is high, and a rate cut becomes a warning. If they soften gently but remain stable, the pressure is manageable, and a rate cut often sparks a powerful rally. This is why the next 90 days matter so much. We are watching these pressure indicators in real time, and the direction they move will decide whether the Fed cut becomes a wealth-building moment or a protect-your-capital moment. And in the next block, I'm going to show you exactly how to read this pressure in a practical way, and what to do depending on which direction it goes. Because timing this part of the cycle correctly isn't just smart. It's the difference between catching the wave and getting hit by it.
Before you think about which assets to buy or how to profit from the next 90 days, we need to talk about the first and most critical step. And it's the step beginners skip every single time. Protect before you position. This might sound boring compared to what stocks will pump, but skipping this step is exactly why beginners lose money right before major market moves. Let me put this in simple terms. You don't build a house during a storm. You secure the foundation first. The market is entering a pressure phase. Volatility is going to increase. Narratives will shift weekly, and fear cycles will pop in and out without warning. If you try to jump straight into positioning while the foundation of the economy is wobbling, you're not investing. You're gambling. So what does protect before you position actually mean? It means doing 3 things. Strengthen your liquidity buffer. During a Fed pivot, markets can move fast, both up and down. If you don't have cash available, you'll be forced to sell at the worst possible time or miss the best opportunities entirely. A liquidity buffer gives you control. It gives you optionality. It gives you flexibility when others panic. Liquidity is not laziness, it's ammunition. Reduce high-risk exposure you don't understand. If you own assets you can't explain in one sentence, you don't own an investment, you own a liability. During volatility spikes, those positions get hit first. They drag down your portfolio. They trap you emotionally. They corrupt your decision-making. Beginners blow up in this exact stage. They hold on too tightly to the wrong assets at the wrong time. Now is the moment to clean up. Separate your emotional money from your strategic money. This is the part nobody talks about, but it matters more than anything.
If every dollar you have is tied to fear or urgency, you will make terrible decisions. Smart investors separate money for bills, money for emergencies, money for opportunity.
When everything is mixed together, You react emotionally to every headline. When it's separated, you think clearly, and clarity is your greatest advantage during a Fed pivot. Here's the core message of step 1. You don't position yourself for upside by taking more risk. You position yourself by having the stability to take the right risk at the right moment. Once you've protected yourself, you're no longer playing defense. You're preparing to play offense. And in the next block, we'll go deeper into step 2, the part where smart investors start quietly positioning themselves while the rest of the world waits for the Fed announcement.
Now that your foundation is protected, we move into step 2. And this is where smart investors silently gain an advantage. You position during expectation, not during the announcement. Here's what most beginners get wrong. They wait for the Fed to officially cut rates before they make a move. It feels safer. It feels more certain. It feels logical. But it's completely backward. Historically, the majority of the upside happens before the Fed cuts, because markets move on expectation, not confirmation. Let me show you why. Imagine you're at a concert, and you hear the crowd start cheering before the main artist steps on stage. You're not cheering because you see the artist, you're cheering because you know they're about to appear. Markets behave exactly the same way. Investors don't wait for the Fed to say, "We're cutting rates today." They react to the signals leading up to it. Press conferences, softening economic data, shifts in Fed language, rising recession probabilities, market pricing and rate path probabilities. By the time the announcement comes, the big moves have already begun. This is why step 2 matters so much. Your goal is to position yourself while everyone else is still waiting for permission. During this expectation phase, liquidity hasn't fully returned yet, but confidence slowly starts to build. That's when early rotations begin. Risk assets start waking up, growth stocks catch small bids, certain sectors flip from neutral to optimistic. Volatility becomes opportunity instead of danger. But here's the nuance. This doesn't mean go all in. Expectation is not confirmation, it's positioning. You're not betting everything, you're tilting your strategy. You're aligning yourself with the direction money is about to flow. Because once the Fed officially cuts, the window of early positioning starts closing. Beginners enter late. Smart investors are already inside. And in the next block, I'll show you exactly which assets historically move first during this expectation phase, and why choosing the wrong ones will cost you a lot more than missing out.
All right, now that you understand when to position, we need to talk about what actually moves first during a Fed pivot. Because here's the uncomfortable truth. Not every asset benefits early. Not every asset reacts the same way. And not every asset is safe in this early window. If you pick wrong, you're going to feel like the opportunity wasn't real, but it was, you just weren't in the right place. So let's break down the assets that historically lead before the Fed cuts. Growth stocks with strong balance sheets. When rate cuts are expected, borrowing becomes cheaper, and companies that rely on future earnings suddenly look more attractive. But here's the nuance beginners miss. It's not all growth stocks. It's the ones with strong cash reserves, low debt, consistent revenue, and scalable business models. Expectation favors strength, not desperation. These companies don't need the cut to survive, they benefit from it. Tech and innovation sectors. Tech is always one of the earliest movers in a pivot. Tech valuations are extremely sensitive to interest rates. As rates fall, or are expected to fall, future earnings become more valuable today. This makes tech one of the purest plays on a rate cut cycle. But again, it's not about chasing hype. It's about understanding that lower rates mean higher valuation potential for companies with long-term growth runways. High-quality bonds start bottoming out. This surprises beginners every cycle. Bonds typically fall during periods of high rates. But as expectations for a cut rise, yields start dropping and bond prices begin creeping up. Smart investors quietly accumulate here because bonds become both a hedge and a return driver during the transition phase. Beginners ignore this completely. Professionals don't. Certain real estate segments start showing early signs of life. Not the whole real estate market, but parts of it. Especially REITs with strong balance sheets, sectors tied to technology, logistics, data centers, and housing-related stocks that benefit from cheaper mortgages. These don't explode immediately, but they stop falling, they stabilize, and then they begin trending upward during expectation. That's your early tell. What doesn't move early? And this is crucial. highly speculative crypto, and profitable small caps, meme stocks, turnaround stories, high-tech companies. These are late movers, meaning they move after liquidity fully returns, not during the expectation phase. Beginners jump into these too early every cycle and get crushed by volatility. Here's the big takeaway for step 3. The early movers are not the riskiest assets. They're the most fundamentally sound. The market rewards stability during uncertainty and rewards speculation only after confidence returns. And in the next block, we'll break down step 4, exactly how to scale your exposure as the Fed cut gets closer, so you don't overextend too early and don't enter too late. Now that you know which assets move first during a Fed pivot, it's time to talk about something even more important: how to scale in safely. Because picking good assets isn't enough. Timing isn't enough. Expectation isn't enough. If you increase exposure the wrong way, you erase everything you gained from the earlier steps. So here's the rule. You don't go all in. You don't stay all out. You scale in strategically. Let me show you how this works. Start with a light, strategic position. During the expectation phase, certainty is still low. Narratives can flip quickly. Volatility is higher than usual. So instead of jumping in aggressively, you start with a small position, something that gets you exposure without putting your portfolio at risk. Think of this like dipping your foot in the water instead of diving headfirst. If the expectation proves correct, you're already in. If it doesn't, the damage is minimal. This is how professionals manage uncertainty. Add with confirmation signals, not headlines. There's a huge difference between headlines and signals. Headlines talk about Fed officials making vague comments, inflation reports, market rumors, opinion pieces. Signals are actual market behaviors, like yields falling consistently, volatility contracting, credit spreads tightening, early movers showing strength for multiple weeks. You add exposure when signals align, not when a headline scares or excites you. Increase exposure as pressure eases. Remember the financial pressure indicator from earlier? The moment the pressure starts easing, even slightly, the risk of downside drops and the potential for upside increases. This is the window where scaling in becomes safer. You don't need perfect timing. You don't need to predict the exact bottom. You just need to recognize the trend of easing pressure. Consumer spending stabilizes, delinquencies flatten, job market shows resilience, business sentiment improves. When pressure eases, liquidity calls begin, and that's your cue. Final scaling happens after the first cut, not before. This is the part beginners always get wrong. The announcement itself isn't where the big gains start, but it is where liquidity becomes clearer. Professionals scale the final portion of their positions after the first cut confirms the direction, not because they needed permission, but because they now understand the strength of the trend. Here's the big takeaway. Scaling in protects you when you're early and rewards you when you're right. It removes emotion and replaces it with method. And now that you know how to scale safely, we can finally talk about the part everyone wants to know: which opportunities explode after liquidity fully returns, and how to position yourself before they do. This is the theme of the next block.
All right, now we enter the part of the cycle everyone gets excited about, the post-cut momentum phase. This is where the big moves happen, not the early signals, not the positioning phase, not the cautious rotations. This is where liquidity truly returns, where confidence strengthens, and where the market starts rewarding risk more aggressively. But here's the secret. The assets that benefit the most after the cut are not the same ones that move first. If you confuse these two groups, you either enter too early or miss the wave entirely. So let's break down the assets that historically surge after a confirmed rate cut. Small caps start catching up fast. Early movers are the big, stable, predictable companies. But once liquidity returns, the smaller companies, the ones that struggled during high-rate environments, start to accelerate. Cheaper borrowing helps them disproportionately. They finally breathe again. They finally expand again. They finally attract capital again. Small caps don't lead the cycle, but when they move hard. High beta stocks wake up strongly. These are the companies that move more than the market, both up and down. During high rates, they suffer. During uncertainty, they stay flat. But when the Fed cuts and liquidity flows in, they flip like a switch. If the early movers represent stability, these represent velocity. Speculative tech becomes attractive again. Earlier, we focused on strong balance sheet tech. But after the cut, another group benefits: unprofitable innovators, early-stage tech, high-growth potential companies. When money becomes cheaper, funding becomes easier, and investors are more willing to price in future growth. These companies aren't safe early on, but they thrive once confidence returns. Crypto typically reacts with high volatility, but strong direction. Crypto almost never leads the pivot. But once liquidity comes back, and once markets regain confidence, crypto reacts brutally fast. Risk-on assets thrive when money becomes easier and inflation risk subsides. That's why crypto's strongest rallies often start after a confirmed rate cut, not before. Real estate stocks catch a second wave, not the early stabilization we saw before. This is different. Lower mortgage rates, more demand, better earnings expectations, stronger investor confidence. REITs, home builders, and housing-related sectors often accelerate after the cut is confirmed. The big lesson of Step 5: early movers give you stability. Momentum movers give you acceleration. If you enter momentum plays too early, you get crushed. If you enter too late, the gains are gone. But if you follow the sequence, protection expectation, early movers, scaling momentum, you're positioned exactly where you need to be when liquidity finally returns. And now that you know where the biggest opportunities show up, it's time for what may be the most important block of all: how to avoid the psychological traps that destroy beginners during Fed cycles, even if they follow the right steps. Now we need to talk about something uncomfortable, because even if you follow every step in this framework, even if you understand the timing, the assets, and the rotation, there are psychological traps inside every Fed cycle that silently destroy beginner investors. And if you don't see them coming, you'll fall into the same patterns that wipe out thousands of people right before the market takes off. Let's break down the biggest ones. The "I'm too late" panic. This trap hits right when the market starts moving. Beginners see early movers pumping and instantly feel like they missed the opportunity. So they chase the trend, but they chase it at the top. They're reacting to emotion, not strategy. What they don't realize is, early movers are not the only phase. Momentum plays are not the only phase. Rotation never happens all at once. There's always a second wave if you follow the sequence. The all-in confidence illusion. Once beginners see 1 or 2 green weeks, their brain flips from fear to overconfidence. Suddenly they want to double their positions, abandon diversification, take on more risk, switch into speculative assets prematurely. But here's the truth: the strongest rallies punish the impatient before rewarding the prepared. A Fed-driven cycle isn't a straight line. It's violent, choppy, deceptive. If you treat it like a lottery ticket, the market will humble you fast. The "I'll wait for certainty" trap. This one is deadly. Some people don't become overconfident, they become paralyzed. They say things like, "Let me just wait until the Fed actually confirms the cut. Let me wait until inflation is clearly down. Let me wait until things look safer." But waiting for certainty is the most expensive form of waiting. By the time certainty arrives, the market has already priced it in. The investors who win these cycles aren't reckless, they're prepared. They don't guess. They don't pray. They position. This short-term noise spiral. This happens to almost everyone. You create a long-term strategy, and then a single red day makes you doubt everything. A headline, a tweet, a small inflation revision, one bad earnings report, and suddenly you're sabotaging the plan you spent weeks building. But here's what's hard for beginners to accept. Short-term noise is designed to steal your attention, not your strategy. During Fed pivots, volatility is normal. Pullbacks are normal. Whiplash is normal. You don't win by predicting every move. You win by staying consistent through the noise. The peak euphoria exit. This is the final trap. The moment when the rally feels unstoppable. When every asset is green. When YouTube, TikTok, and your cousin at the barbecue are all screaming that this is just the beginning. That's when beginners finally go all in. And that's usually when the market takes a breath and knocks them right back down. You don't exit on euphoria. You manage on structure. The core lesson of Step 6. Most investors don't lose because they pick bad assets. They lose because they brought the wrong mindset to the right moment. Patience beats panic. Structure beats emotion. Timing beats excitement. And with the psychological traps exposed, we can now move into the final and most practical part of the video. Exactly how to build your 90-day plan for the upcoming Fed cut. and how to position yourself like a professional, not a gambler. All right, now that you understand the cycle, the signals, the rotations, and the traps, let's turn everything into a simple 90-day plan you can actually follow. This is where people finally stop guessing and start acting with intention. Here's exactly what the next 90 days should look like if you want to position yourself before the Fed cut and not after everyone else has already moved. Days 1 to 30, prep plus protection. This is the foundation. Nothing else works without it. Clean your balance sheet. If you're overloaded with high-interest debt, your returns will be eaten alive. Attack the worst rates first. Build or reinforce your cash buffer. Volatility is guaranteed in pivot cycles. Your cash isn't a sign of weakness, it's your oxygen tank. Define your risk limits. Before anything else moves, decide how much volatility you can stomach, how much you're willing to allocate early, how long you're willing to hold. This isn't the fun part, but it prevents the emotional mistakes that destroy beginners. Days 31 to 60, positioning plus early rotation. This is where strategy starts. Build exposure to the early movers. These are sectors historically first in line when expectations shift. Large cap tech, mega caps with strong balance sheets, defensive growth, quality companies that thrive even without a cut. You're not chasing hype, you're aligning with history. Scale gradually, never emotionally. Add exposure in increments. Stop trying to time the exact bottom. The power is in the positioning, not in the perfection. Days 61 to 90, momentum plus opportunity windows. This is where the acceleration typically starts. If expectations firm up, add momentum plays. This is not for the first 30 days, and it's not for the hesitant phase. Momentum comes after structure. Depending on your risk profile, this may include small caps, high beta stocks, speculative growth, crypto, early stage tech. But remember, this works only if steps 1 to 5 are already in place. The core principle of the 90-day plan. You are not trying to predict the cut. You are not trying to win the lottery. You are not trying to beat hedge funds at timing. You are doing what almost no beginner ever does, building a structure that positions you ahead of the wave instead of reacting to it. Look, the next 90 days won't magically make you rich, but they can put you in the small minority of people who understand how the Fed cycle actually works and use it to their advantage. If you follow this sequence, prep, position, scale, momentum, you'll be miles ahead of everyone who only starts paying attention after CNBC announces the cut. Your future self will thank you for acting early, not perfectly, early. And if you want me to break down exactly which assets historically perform best in each phase of a Fed pivot, make sure you're subscribed, because that video is coming next.